Coronavirus fears
The coronavirus is here. The stock market is crashing.
wiped out all of this year's stock market gains,
I've got to get to higher ground.
announcing the first coronavirus death in this country.
There's no reason to panic.
Todd, where have you been?
I had to get out of town. The coronavirus hit. I had to just head for the hills. But I found this stock market crash survival guide.
Let me see that. It's the stock market crash
I
survival
thought it might
guide.
be.
Well, the market's off 4,000 points since I
What?
last saw you.
Oh my goodness.
We had a 1,200 point drop,
Yeah?
single day drop in the Dow.
Oh, my.
That's the biggest one day drop in the history of the Dow.
So glad I left town. I was in the jungle.
Let's jump right in and show our investors how to survive this market.
Let's do it.
So guideline number one, this is the time to stop, take a look at your investment portfolio, and make sure you are investing long-term money.
Long-term money means 3, 5, 10, 15, 30 years. You're going to put it in, set it, and forget it.
If you need this money over the next 24 months, you should not be investing it. You're going to feel it. This type of pullback in the market is really going to accelerate and leverage the amount of emotions you're going to be feeling
You're gonna
and
be
basically
stressed.
make it impossible for you to get through this correction.
You already need to have your emergency fund set. 3 to 6 months, 12 if possible, of expenses in the bank. Set aside, don't touch it.
As traders, when we use money that we have an obligation to spend in a short amount of time, we call this borrowed money. And when you invest borrowed money as a trader, you're basically stacking the two biggest obstacles against you becoming a successful trader, which is fear and greed. These two emotions get accelerated or leveraged when you're using borrowed money.
And borrowed money should not be investable money. Mike, you've always said avoid leverage, futures, options, margin, especially margin. Stay away from it.
So tempting to accelerate the growth of your portfolio in an up market and go ahead and buy that 6% margin at Robinhood.
Bad news.
But when the market goes down, it's really going to disable your ability to get through those corrections.
And it will stress you out as an investor.
Adding leverage or borrowed money to your investments is like throwing gas onto a fire.
Oh yeah.
So market pullbacks are a great time to stop, check your portfolio, and just make sure you're investing long-term capital, because that money will be able to make it through the down and the up of the next market. If you have short-term money in the market, take it out.
All right, so what's the second guideline, Mike?
So number two is to check your risk appetite. What's your sleep barometer looking like right now?
Sleep barometer, I like that. What does that mean?
This is your ability to sleep at night. If the coronavirus, if the market being off 1,000, 2,000, 3,000 points is biting into your sleep time because you're waking up at night, you're sweating
Thinking
bullets,
about your portfolio.
then you have taken too much risk in your portfolio.
You need to be sleeping easy.
This is another time to stop, gauge your risk appetite, and say, have I invested my portfolio too aggressively for this type of a market?
Right. And you're not thinking long term.
Well, and if you can't focus at work because you're thinking about the stock market,
Too much risk in your portfolio.
and my advice is not to try to forecast a stock market crash or a recovery period, but just know they will come.
All right, this is good. What's the third guideline, Mike?
So the third guideline is to know what you own and to know why you own it.
You should be able to explain this to other people.
If you can't explain what you own, how in the world are you going to be able to hold it through a down market? It's just impossible. You have to know what you own and why you own it.
And you're owning it for the long term. So you're not coming in and out of the market trying to time the market.
For example, Todd, what's one of the positions you hold in your portfolio?
The S&P 500.
So what is it?
It's the top 500 companies in America.
And why do you own it?
Because I believe in the success of those top 500 companies to drive the performance of my portfolio.
Okay, that's perfect, because a lot of times investors will jump into ticker symbols or products they don't even understand, and when the market goes down, if you can't explain it to yourself what you hold and why you hold it, good luck holding it through the ups and downs of the market. You just can't do it.
And avoid FOMO at all costs. The fear of missing out will drive you into areas that you don't have a clue about. Avoid them. Go with what you know and what you can understand.
Right, and if you know what you own and why you own them, that gives you financial confidence.
And investors love to have financial confidence.
Number 4, make sure your portfolio is diversified. Sounds complex, but now it's as easy as owning an index fund.
Just make sure that the index fund tracks a broad market index.
Like the Russell 1000, the Russell 2000, a total stock market index.
Yeah.
An example to stay away from, I think, would be, in terms of diversification, the Dow Jones Industrial Average.
Only has 30.
30 companies. So that would be one that I wouldn't say is diversified.
Right. Diversification is as easy as owning an index fund. And the S&P 500 has 80% of the entire market capitalization. So it's super easy.
The less diversified you are, the more risk your portfolio takes, both on the upside and on the downside.
That's right.
Number 5, buy the dips. As investors, we're long-term buyers. We believe the market's going up over time. So when the market does pull back, we buy the dips.
The stock market does not grow in a straight line. It's like a living, breathing person. It goes up and down.
Right, and if it did go in a straight line and it was that predictable, as investors, we'd only get a risk-free rate of return,
It'd be boring.
like the rate of inflation or a treasury bill.
That's right. So as an investor, if you want to buy low and sell high, you have to stick to your plan. Hold in the face of fear. This last week with the coronavirus, you were to hold in the face of fear, or even buy in the face of fear.
Which would be like dollar cost averaging.
Right.
Those of you who put $100 a month or $1,000 a month into the market,
Smart.
your $1,000 put into the market today buys a lot more shares than it would have bought last Friday.
That's the truth.
Finally, keep in mind that the up and down movements of the market may not have any correlation to the companies you own. For example, Amazon.
Still open for business.
Are you thinking, I know it's scary, I know you think your portfolio is going to go to zero, but is Amazon going to go to zero?
No.
Is Amazon going out of business?
No.
Is Apple Computer going out of business? Is Google going out of business right now?
Chipotle still open.
So we're scared about this coronavirus. We don't know how far it's going to expand. The market's pulling back. Everybody's preaching doom and gloom.
Hold firm.
Think for a moment. Back up. Are these companies still open for business?
Absolutely.
And are you thinking they're all going to shut down? Because
Not at all.
that's what you're saying when the market goes to zero. So at the end of the day, ignore the noise and go live your life. The stock market's going to go up or down. I know with it down 4,000 points,
It's scary.
it is scary. But as investors, we're long-term buyers of the market. So go live your life.
Save your energy on the things that are important. Family, friends, and Chipotle. That's what I do.
That's what I'll do.
Starting to get blisters. Kidding.